Disclaimer: this video is intended for informational purposes only and should not be considered financial advice. Welcome aboard our journey into the world of investing. It's an exciting landscape filled with opportunities to grow your wealth and secure your financial future. Today, we'll be exploring the basics of various investment types, from stocks to insurance policies. Each holds its own unique benefits and risks. Remember, investing isn't a get-rich-quick scheme, it's a long-term strategy for financial success. Investing is a crucial part of financial success, and we're here to guide you through the basics. Stocks represent a share in a company's ownership. That's right, owning a stock means you own a tiny piece of the company you've invested in. Companies issue stocks to raise funds for various projects or expansions. In return, as a shareholder, you get a claim on part of the company's earnings and assets. Now, investing in stocks can be a bit of a roller coaster ride. The value of your stocks rises and falls with the company's fortunes and market conditions, which can be unpredictable. That's where the risk comes in. But here's the exciting part. Stocks have the potential for high returns. If the company you've invested in does well, you could see a substantial increase in the value of your stocks. You could even receive dividends, which are a portion of the company's profits distributed to shareholders. And remember, investing in a variety of stocks can help spread the risk. This is called diversification. While stocks can be a risky investment, they also offer significant potential for high returns. Bonds are essentially loans that investors make to entities like governments or corporations. Think of it like this: you're the bank, and these entities are taking a loan from you. In return for your investment, they promise to pay back the original amount, also known as the principal, at a specified maturity date. What's more, they'll pay you interest periodically along the way. Now, bonds come in various flavors. Government bonds, also called treasury bonds, are issued by national governments. They're often seen as safe investments because they're backed by the full faith and credit of the government. On the other hand, corporate bonds are issued by companies. These tend to offer higher interest rates due to the higher risk involved. The interest payments from bonds, known as coupon payments, are your returns. They're usually fixed and paid semi-annually, providing a steady income stream. Bonds are generally seen as a safe investment, offering regular interest payments to the investor. Mutual funds are investment vehicles that pool money from multiple investors. Think of them as a collective investment pot, where everyone chips in and the total amount is then invested across a variety of assets, such as stocks, bonds, and other securities. The beauty of this approach is that it provides you with exposure to a diversified portfolio, which can help to spread risk. One of the key attractions of mutual funds is that they are professionally managed. This means you have seasoned investment professionals making decisions on where to invest the pooled money, based on extensive research and analysis. There are different types of mutual funds to consider. Index funds, for example, aim to replicate the performance of a specific market index. On the other hand, actively managed funds involve a more hands-on approach from fund managers who try to outperform the market. Mutual funds offer diversification and professional management, making them a popular choice among investors. Real estate can be a lucrative investment option. There are two main ways to invest: direct ownership, where you buy property to rent out or sell for a profit, and real estate investment trusts, often abbreviated as REITs. REITs allow you to invest in a diverse range of properties without the need to physically own or manage them. The potential benefits of property investment are tempting. Rental income can provide a steady stream of cash flow, and over time, properties often appreciate in value, leading to substantial capital gains. But don't forget the flip side. Real estate markets can fluctuate, and there's always the risk of property values going down. Additionally, owning property comes with its own set of costs, including maintenance, property taxes, and potentially steep mortgage payments. While property investment can be profitable, it also comes with its own set of risks and challenges. It's important to do your homework and consider all factors before jumping in. Money market funds are ideal for short-term investing. They are a type of mutual fund that invests in high-quality, short-term debt instruments like treasury bills and commercial paper. Think of them as parking lots for your cash, providing a safe place to keep your money while still earning a little bit of interest. One of the key benefits of money market funds is their stability. Unlike stocks or bonds, the value of a money market fund doesn't fluctuate much, which means they are low risk. They also offer liquidity, which means you can easily access your money when you need it. However, with low risk comes low return. The potential returns from money market funds are typically lower than those of riskier investments, such as stocks or bonds. There's also the risk that the return may not keep up with inflation, causing the purchasing power of your money to decrease over time. Money market funds offer stability and liquidity, making them an excellent choice for short-term investors. Retirement plans are an essential part of long-term financial planning. They come in various forms, each with its own set of benefits. Let's start with the Individual Retirement Account, or IRA. It is a personal retirement savings plan that offers significant tax advantages. It allows you to contribute a certain amount each year, and these contributions are often tax deductible. Another popular retirement plan is the 401(k), typically offered through employers. Like the IRA, the 401(k) provides tax advantages and allows for larger annual contributions. Some employers even match a portion of your contributions, essentially offering free money towards your retirement. Regardless of the plan you choose, the key is to start saving early. Thanks to the power of compound interest, even small contributions can grow into a substantial nest egg over time. This is why retirement planning is so crucial to your financial future. Remember, the earlier you start saving for retirement, the better off you'll be. Insurance policies provide financial protection and peace of mind. Just as we've discussed various investment methods, it's equally important to recognize the role of insurance in your financial plan. It acts as a safety net, safeguarding your financial stability against unforeseen circumstances. Consider life insurance, for instance. A life insurance policy can support your loved ones financially in the event of your untimely demise, ensuring they can maintain their standard of living. Similarly, disability insurance is another vital policy that provides income if you're unable to work due to illness or injury. Health insurance, auto insurance, and home insurance are other common types that protect your finances from major health issues, accidents, and property damage, respectively. Each type of insurance is tailored to cover specific risks, offering a buffer against potential financial loss. In essence, insurance policies are a financial tool that mitigates risk. Insurance is a crucial part of any comprehensive financial plan, providing protection when you need it most. Investing is a journey that requires careful planning and consideration. We've journeyed through the landscapes of stocks, bonds, mutual funds, property, money market funds, retirement plans, and insurance policies. Each offers unique benefits and risks. It's crucial to explore these avenues, understand them, and make informed decisions based on your financial goals. A financial advisor can be your compass, guiding you on this path. Thank you for watching. Don't forget to subscribe for more informative content on investing and financial planning.